Yeah, first of all, I think it's important that we step back and consider just the historical magnitude of what's happening. To see the 10-year yesterday, I think it hit 1.32%, the all-time low in terms of yield. I think about that myself and I say, who is it that's buying these bonds? Who's willing to lock up their money for 10 years for only 1.32%? And I think the answer to that, of course, is people are fearful. There's all kinds of concerns, uncertainty, whether it be the coronavirus, whether it be the election. So people are willing to take gains off the table and lock in that money over the long term at 1.32%.
Right. So what you're basically saying is you just look at the 10-year and get freaked out. And my question to you is, so do the rest of us. So you're the bank CEO. So,
yes.
So why don't you give us a sense, if you can, about what the real change in activity is that you're experiencing, if any? I mean, this is the central question.
Sure. Yeah, that's the central question. And right now it's premature. We're not experiencing any change in activity, which is the good news. To the contrary, this can be positive for our consumers in terms of being able to refinance at lower rates. If you think about the impact of banks, over the long term, you will have a lower interest if these low rates persist. You will have lower earnings on long-term assets like 30-year fixed-rate mortgages, like the mortgage bond portfolio they may have. But that will take time to play out. Over the short term, banks have the opportunity to lock in low long-term interest rates, which can be a good thing. So as you were talking about the sell-off in bank stocks and all stocks, it's premature in my mind.
Yeah,
we have not seen that. In fact, the economic activity remains robust.
Okay, which is reassuring. And like you said, there might be some upside here from the refinancings. You know, there's also, in some ways, the impact the way, I should say, that low interest rates can juice the bad kind of borrowing. And that's what I'm thinking about a lot lately. I mean, yields on muni bonds are at 38-year lows, and we know, some of these states and our region particularly are over-indebted, and more borrowing is probably going to hurt more than it helps in the long run. So turning to your corporate customers, are you going to get worried or increase underwriting standards, anything like that, as a result here?
If this persists over the long term, it's certainly something we will look at, but we're not going to overreact. We're seeing our corporate customers do exactly what everyone's doing in terms of investors. People are stepping back and asking questions as to why and what impact will this have. And, it's easy now to say we may be overreacting. Only in hindsight we'll know. But we've endured a whole lot in the past 5 years, and we've been able to rebound. And if you think about stocks, and if we thought they were fairly valued last week, it's a buying opportunity for true long-term shareholders.
All right, Brent, taking the long view and staying positive, we thank you for joining us today.
Happy to be here. Thank you.
Brent Beardall is the CEO of Washington Federal.